This is Bank of America speaking now. They say a 10% increase in gold demand at the source would increase, physical gold, would increase price to $3,500 on average for 2025.
Welcome to the Morning Markets and Metals with Vince Lanci, where each morning Vince brings you the financial and precious metals news to get you ready for your day. And now, here's Vince.
Good morning, everyone. It's 6:48 in the morning, and I thought I'd do a quick hit on the markets and read an excerpt from a report that I'm looking at today. Let's start with 10-year yields. They're trading 453, unchanged. The dollar is 107.01, down about 5 bips. The S&P 500 is 61.02, down about 9.5 handles. The VIX is 1541, up 30 basis points. Gold is 29.29, up about $1 and weakening. It's off the highs. Silver is also off the highs, but still much higher overall. It's trading 33.12, up 79 cents, up 2.5%. It was up 3% about an hour and a half ago. Copper is straddling unchanged at 476, currently up about a tenth of a penny. WTI is down 3 cents, 71.77. Natural gas is 388, up 6 cents, up about 1.6. Bitcoin is 96,780, also straddling unchanged, up 190. Palladium is 1,000, up $4. Platinum is 1,001, up $4. The gold-silver ratio is finally cracking lower, trading about 88, down 2.5%. Grains, soybeans are 10.39, up 10 cents. Corn is 4.93, up 5 cents. And wheat is the strongest of all, up 6.02. Trading 6.02, up 12 cents. Bank of America has an incredibly thorough report entitled Gold Primer. And the purpose of that report is very educationally biased. It would be something like we would write for subscribers to get a handle on terminology and how things go. However, it's coming from a bullion bank, and that makes it extremely interesting to us. And the interest comes into realization that what Bank of America is doing is it's preparing a whole new cohort of potential buyers or traders to come into the market, namely their equity side. Massive money, hedge funds, equity-only institutions are again looking at gold, and not just to be long or to be short or to play directionally. This report goes into all the venues, the whole market. It describes the EFP. It describes arbitrage situations. It describes things that would create backwardation in gold. Very rare, but it happens. It truly is a primer. And for them to do this, to divulge or disclose this much, it's really an educational marketing piece. And they must recognize increased interest globally. And we have touched on this. We have pretty much said this over the last month, that Hartnett's writing has been very focused on what his equity people are doing and what they will be doing going forward. For example, he had said their equity people should be going into international stocks. And we had said if you're putting people into international stocks, you're also putting them into gold, because gold is like an international stock. It is like an emerging market, and it is on everyone's radar. And as late as last week, we said, trying to skate where the puck will be, we said Hartnett's going to start recommending miners. Or put it this way, Hartnett's team on the equity side will start recommending miners, and we firmly believe that. But for today, we want to read to you an excerpt from it focused on gold. They have many sections in the report, but this one section I think we can share without boring you to tears. All right. Subtitle, Bank of America. We remain constructive gold. Macro remains supportive. We reiterate our constructive gold view with a $3,000 an ounce target, as the macro backdrop remains very constructive. Indeed, fiscal imbalances in the U.S. and other countries make the yellow metal an attractive asset to own for central banks. Persistent uncertainty over the policies of the U.S. administration, alongside apprehension over trade disputes, also make gold attractive. Interestingly, the gold market entertains sometimes, quote, extremist, end quote, theories that are often hard to fully reconcile. To that point, for a long time, gold bugs have often thought that, quote, governments and banks have a vested interest in keeping gold prices low. High gold prices are often seen as a signal of weak confidence in fiat currencies. If gold were allowed to rise freely, it would expose the true extent of currency devaluation and the risks associated with excessive money printing, end quote. He's describing the extremist gold bug types, or anti-fiat. But then last week, the FT ran a much-read story that, quote, the unimaginable becomes the imaginable, and there is speculation, quote, about a revaluation of America's gold stocks. Currently, these are valued at just $42 an ounce in national accounts, but knowledgeable observers reckon that if these were marked at current values, 2,800 when this was written, this could inject $800 billion into the U.S. Treasury General Account via a repurchase agreement. That might reduce the need to issue quite so many Treasury bonds this year. On the second argument, not reprinted in full, we agree that the U.S. fiscal picture is not the strongest, and that has been key to our bullish gold call. But the argument of transmission was very different. I'm reading a couple titles they have of other articles that they're marketing. The argument for transmission was very different. Essentially, parenthetically, what they're saying is gold isn't benefiting from treasuries. Not really something to go into right here. They don't flesh it out. Next, so while we are somewhat suspect of both theories above, the gold bug extremist theories, even the FT giving it credence, we agree that the gold market is pricing in increased policy tensions. To pick just one, tariffs should at least initially put upwards pressure on U.S. dollar. Full currency view. See World at a Glance, Tariff Talk, 22 January 2025. But then there is a view among U.S. policymakers that the U.S. dollar is too strong anyway. Accompanying this, they call for a weaker U.S. dollar is also discussed with a push to rebalance external accounts. On balance, and all else equal, lower current account deficits are a drag on capital inflows, but there are calls for the U.S. dollar to retain its reserve status, with central banks de-dollarizing into gold. So, to sum up, keeping in mind that this whole report is geared towards initiating a whole new class of investor into the gold world. That subsection of the report gives their opinion. They are constructive on gold. It attempts to educate and potentially inoculate them against extremist views. And they're not saying extremist views in a negative light. They're saying that some of these extremist views happen to be coming true, and they cite the Financial Times coverage of it. They don't think that the dollar is in trouble. This is what the last part means to us. They don't think the global reserve currency is in any trouble. They do, however, note that central banks are de-dollarizing by buying gold. Essentially, they're saying a version of what we've been saying. It's not about dollars, it's about treasuries. The global reserve currency can remain the dollar. It can be puka shells, as long as they have the U.S. Stamp of approval on them. What matters is the store of value, the reserve asset, the thing that you put your money in when you're not making it work to grow your economy. The way you save your wealth is no longer treasuries, or at least no longer treasuries as much. And gold as a tier one asset is now competing with that. Overall, this is an excellent report. Definitely for the uninitiated as well as for the initiated. We've been saying most of the things in this report for 4 years in various forms, but it's really nice to get it in one spot. It's nice to get it articulated in a dry academic fashion like this. And we're going to do a write-up on it, but there's really not much to comment about it except to say, yes, with one exception, this section here, you're no longer an extremist gold bug if the mainstream is talking about your opinions. How does the expression go? They laugh at you, they ignore you, they hate you, and then they end up agreeing with you, that type of stuff. Well, that's what's going on here. And billions and billions of dollars are on the sidelines that have no exposure to gold. This is the moment that gold people talk about. Gold is underexposed in portfolios, et cetera, et cetera. Well, this is what's happening. These people are going to put money into gold. They're going to go, what's our gold allocation? 0.01%. Okay, take it up to 2%. And in a sense, the people who wrote this are really, they're mirroring what's going on in China. See, China is opening up its system to insurance companies, right? They're encouraging insurance companies to own it. And China, in many senses, is leading world growth, more than one. And now they're opening up the market there. So if China companies want to own gold, then maybe we should own some gold too. You know, it's like keeping up with the Joneses or the Wangs or whatever the equivalent for Jones is in China. Anyway, that's it. Here, that's your Valentine's Day gift. We're going to have the full report this weekend for premium subscribers. For now, I read you a section of it. Enjoy the markets today. Hopefully silver keeps its gains. Note that yesterday we put out a report unrelated to this. We put out a report, the Goldfix gold monetization thesis, which is something we've been holding back on, waiting for a piece of the puzzle to drop that would make it make sense to us. And that puzzle piece dropped, and it's in the article, and you can read about it. Now that we have gotten through all that, we kind of buried the lead. So here's the lead for you. In the next section, which we're just going to touch on here, the title is Gold Investment Demand Increasing by 10% equals gold at $3,500 an ounce. Now looking into flows, they have an exhibit which shows their gold supply and demand model. They model gold on a series of assumptions, including mine output, scrap supply, and gold fabrication and jewelry demand. And they go through a very detailed, very good explanation of it. But here's the lead within their story that's being buried. All the banks, Goldman, Bank of America, Citibank, all the big heavy hitter bullion banks have changed their modeling. They no longer talk about correlations and rates. They talk about demand. And they say, this is Bank of America speaking now, they say a 10% increase in gold demand at the source would increase, physical gold, would increase price to $3,500 on average for 2025. Now, that's not a small figure, 10%. However, if China's insurance demand were to come in as projected, it would increase percentage by about 6%. So that's 6% of the 10% right there. The other 4%, if it were to happen, would come from the very people that Bank of America is talking to in this report. The people that have no allocation in gold, but need to have allocation in gold because other companies, especially insurance companies, are offering it. So that's the headline right there. I'm Vince. Happy Valentine's Day. Have a great day. Pardon my cold. Enjoy the weekend.
Well, thanks for watching this morning's Markets and Metals with Vince Lancy in what sure has been an exciting week in the gold and silver markets. Hopefully the show has been a helpful guide as we navigate a lot of what's going on in the world. And in either case, appreciate you watching and being here. Hope you're getting set for a great weekend. And before we wrap up, just wanted to thank Fortuna Mining, who is today's sponsor for our show, and actually was talking with our dear friend Dave Kranzler about Fortuna in an episode earlier this week, and we'll play a couple comments from what he had to say.
I think that Séguéla mine alone is worth the market cap of Fortuna. And it just, I mean, I just can't believe how much gold they're finding on there. I mean, now they have 6 deposits that they can mine, and they've got a 7th that, that probably be, if they're ready to mine it, and if it, and if it fits in terms of the grade, if it improves their sequencing, they probably start mining that next year. Then they've got those prospects in the northern part of the property. The name escapes me right now, and I was not expecting that to be included in the revised inferred resource, but it was. So, and they've got, I think Jorge said they've got over 30 different targets that they still want to test, at least that they know of now. So it looks to me like eventually, and again, they've already exceeded the production from that mill without spending money on increasing the physical size of it, right? The processing capacity. So at some point down the road, they'll probably end up doing that. They got to find enough resource to justify it. But in my mind, there's no question they will. And then you've got the Diamba Sud project, and it looks like, that thing could end up being more valuable than it was thought when they acquired it. So I think if you buy Fortuna at this price level, you're getting everything except the Séguéla mine for free. So to me, it's a very undervalued stock.
Well, thank you, Dave. Thank you, Vince. And thank you to everyone watching at home. I sure do hope you had a great week. Go out there, have a great weekend, and we will see you again on Monday. Please note that this video is not intended as legal licensed financial trading advice and is to be used for informational purposes only. Please contact your financial advisor before making any decisions, and thanks for watching.